And good morning, everyone. John Hutchinson with Traders Reserve, along with Jeff Wood for Breakfast Club, August 18th. It is 8:30 a.m. The Starbucks French roast is in the cup. Jeff, what's your drink this morning?
I have hazelnut something, a hazelnut medium roast, which will probably put me to sleep in like an hour. I need a dark roast.
Well, as we talked about last week, we were watching the rise of costs in the service sector, and the PPI report largely confirmed that rise. Jeff will have more detail on that as he takes a deeper look at both CPI and PPI in today's show. Market largely ignoring that for right now. My read is that the PCE report really the only one that will truly matter to the Fed and ultimately to Wall Street. See if that transpires. Should be a quieter week. There are a couple of events which Jeff will walk you through, but most of the data, big data and earnings are behind us now. We're also in the back half of August, which tends to be lower volume, lower volatility, crappy premiums, and Wall Street traders on vacation. So expect a quieter week across the board. Hopefully, a little bit of consolidation will give us some more impetus to close trades this week. And that leads us to let's just focus on what matters this week: trading and successful trades. So, weekly income report from last week. Apologies, it'll be a little bit abbreviated as we had an internet outage all weekend. So I'm trying to fix things. I mean, like all the technology breaks at once for me, Jeff. I don't know what it is. I've had a computer monitor die. I had the internet out all weekend here, and the television speakers blew out. So, like, this it's got to be a
Oh,
conspiracy.
so
It's a tech
you're getting a new TV too? Jeez.
a new TV, a new computer monitor, and I had to replace all of the hardware and wiring for the internet. So this I swear it's a conspiracy. So if you see a rise in communication services stocks or Best Buy or Apple, that's me. So all right, let's get on with the weekly income report for the week ending last week, August 15th. We closed seven trades. Net income across those seven trades, $1,627. Total capital represented across those trades, $15,828 for a total return on capital of 10.3%. Oh, excuse me. For income masters, another one of those caterpillar slowdown weeks. As we only closed two trades, largely prepping in advance for this week's Income Madness Week event. So for those of you in Income Masters, or if you're attending the special event for Income Madness Week, that begins at noon Eastern today. Dave will be doing a preview session and then live trading all wrapped in one. So that will be in the Income Madness Week channel. Just a reminder on that. But we closed two trades. Average days in trade 19. As the SMH and IMW trades were longer dated trades and took a little bit more time to work out, but they did. Total capital represented by those two trades, $2,639, $301 total net income. So that's enough to go out to dinner, and an 11.4% return on capital. So I would expect Income Masters to get a little busier as we go through this week and next week. We had a lot of August 22 expirations. So for those of you in Masters, make sure you check your open trades. Make sure you know what's due to expire at the end of this week and expect to either hit targets or take actions. And you probably have a pretty busy week with Income Madness Week as well. So, Income Masters, 11.4% return on capital for the week, and bringing our 2025 total so far to 26,413, and for August, a little over $1,200. For our Millionaires Trading Club, did not get this correct. These mm, here and there. You can just cross this out. That was last week's stuff. Another, as we talked about last Wednesday, we had another wild run with the Russell 2000, the RUT, which closed three trades last week. That was most of the net income, closed five total trades, an average of just over 11 days in trade. 13,189 in total capital, $1,326 in net income for a 10.1% return for the week. And Get rid of those. That brings us up to a little over $1,800 so far for the month of August, a much slower month, but sure we'll get that on track and rolling along. 14,543 for total income for Millionaires Trading Club year to date. So with that, let me change this over. I know Jeff has a lot to share with you. So Jeff, you ready to go?
Yep, here we go. That's can never find the right slide. Okay. All right. Can everyone hear me okay? Everything good? See my screen. I don't know why it shows up with so much black border around the whatever. Anyway, we're just gonna go. Okay, so recapping last week, as I wasn't sure if John was going to make it today, so I was trying to do my best John macro impression, kind of going over some of this stuff. But what I see here is the core CPI. So I have a chart of the S&P 500 and what it did last week, and then some of the economic data of last week. We'll get into this week in just a moment. So CPI went from 0.2% the last month to 0.3%. There was so much volatility in what the CPI was going to do month over month. That was really the sort of big movement that we had last week was August 12th when that news came out. And essentially that news gave investors a little bit of comfort saying, hey, inflation, your prices are going up from 0.2% to 0.3% month over month, but they're not going up big enough that a rate cut would be off the table. Now, what was interesting to me was that the PPI, so that's the producer price index, that's how much the producers of goods are paying. I would say skyrocketed. Maybe that's an exaggeration. I don't know. The forecast was 0.2% from zero month over month. It went up by 0.9%. So what we're seeing is core CPI did tick a little higher. So consumer prices are going up, but they were going up within the expectation of the report. PPI really went up. And so what this says to me is if consumer prices aren't going up that much, but producer prices are going up that much, and I'll get John's take on this in a second. But what that says to me is that companies right now are doing what they can to absorb the cost of tariffs. What you then see is core retail sales went down. It was within expectations. I mean, everyone expected a 0.3% month over month increase versus the 0.8 from the previous month. So core retail sales are going down, producer prices are going up, and consumer prices are also going up, but just not as much. And so the question becomes when those three things kind of happen, the question is at what point can companies say we have to pass price increases on to consumers? And if we do, how much will retail sales be affected? And so right now, look, 0.8 to 0.3% in 1 month reading, not the biggest, not the end of the world or anything like that. But at some point, these numbers are likely to merge a little closer together. And when that happens, when these are a little closer together, the question is what will happen to retail sales? So I don't know, John, if you have anything on those three. I'll get to consumer sentiment in just a second. But
I think the thing to watch for in my experience will be the next quarter's earnings, in part because if we roll back the clock and think back to the early spring when tariffs were being announced, and then the announcements came that they would be delayed, etc. We saw two things take place. One was front loading of purchases by both consumers and businesses. And so that's at the business level, that's an increase in inventory, which would allow companies to bear the cost of tariffs, actually not have to bear the cost, right? So you have existing inventory, you build up, front load additional inventory, and then you work to sell that inventory off at its normal cost. And then in the summer, we started to see the transition to companies having to pay tariffs. And now it's a question of at what point does that start to impact earnings? And when it begins to impact earnings, that's the point at which you'll start to see it transition to the consumers beginning to bear the cost. And again, the biggest issue to me is you look at a car, just a car. I mean, I say just the car, and there are probably like 10,000 parts to the car. Well, which parts are tariffed and which parts aren't? It's not as simple as like as say a Nike, which produces a shoe in Vietnam and then ships it back to the US. They know the tariff on the shoe, they know what the cost is. You get into more complex uh, elements in the economy, electronics, automobiles, other elements that are other pieces of the manufacturing strata. And I think it takes time for companies to really understand what's the real cost to them. So, for example, and this is completely made up. So just like let's imagine that we were building a UFO, but only one component of that UFO comes from a foreign country that has a high tariff. Well, how much is the real impact to the cost of building that UFO? Yes, we're talking about UFOs today. I know, isn't that weird? But that's sort of my underlying point is I don't think businesses still have a true handle on every single line item cost and its impact on their bottom line. And that's why you're seeing CPI trail slowly. But the thing that everyone's not saying is CPI is still rising and PC is still moving away from the Fed's 2% target. So those those
Yeah,
those
that's no
pieces
good.
don't, yeah, those puzzle pieces don't fit together for a growing and strong economic picture. So um I I hesitate to say that it's also PPI can also be a volatile report. You can see spikes in short-term periods that then abate.
Yeah, that
So
yep, yep.
I want to see PPI be substantially higher as it was for the month of July for 2 or 3 consecutive months. That's a trend. And then we should be able to see whether or not that begins to translate to the consumer price index in larger rises than a tenth of a point. Remember that last year when I talked about the expectations uh, for Trump's plans for tariffs, when there were no details, there were just very broad brushstrokes. That the general expectation was that the tariffs would have about a 1% impact maximum overall to inflation. So we're seeing that. We're just seeing it very, very slowly. So 1 month is a thing, but it's not a trend. I want to see that for 2 or 3 months.
Yep, agreed. So the other thing that I thought was interesting last week is consumer sentiment is actually heading down. The expectation was for it to go up, yet it went down. And similar to really prices since April, prices in the market have been going up. We're hearing that tariffs are bringing in what 160 billion so far. So things that you would think are positive for the economy, yet consumer sentiment is going down. And so I thought that was really interesting because it's kind of like what's going on in Washington, D.C. All reports say crime is down. Crime has been down for the last 10 years or so. But if you actually go out and talk to people who live in Washington, D.C., I think it was 70% of them all said crime is a significant problem. And so sometimes sentiment is more important than what is going on. So even though the market's been going up, jobless claims have been stabilizing. Some of these other things are going on. We're bringing in money for tariffs, which in theory should be a good thing for the economy. All that other stuff, sentiment is still lowering. So those kind of things are important. I know we're sort of talking about just the week ahead, and this is definitely a little bit more of a
But
macro
let's
conversation. But
let's take that sentiment and put it in a different context, which
sure,
is, as you and I have been saying, consumer behavior is always slow to change.
yep,
Even if you go all the way back to the '07-'08 collapse, financial crisis, whatever you want to call it, consumer behavior was very, very slow to change, even with all of the warning signs that developed in early 2008 with Bear Stearns collapse. It wasn't until the Lehman collapse in September, a difference of nearly 6 months, when consumer behavior truly changed. So that the sentiment side starts to align with what we're talking about here. And what I would actually underline is the inflation expectations rose by 0.4%. So consumers expect to pay more for things in the future, which impacts their view of, or their sentiment of the economy. So these align. And I mean, if there's going to be a slowdown of any kind, the real question is, does it happen in the fourth quarter, or does it happen in the first quarter of next year? And I generally hold to the belief that, uh, especially when things start to change as they have with tariffs this summer, that most people are going to hold out for Christmas. Right there, it's the December 31st, 1919 party, right? It's the day before prohibition kind of thing, right? So look to Christmas sales, if and that's when we after that is when I think we'll start to see consumers really slow down. Although I got to tell you, I was in a grocery store up here. It's no Bear in mind, this is actually a week ago, and they already have Halloween stuff out. I
Oh my
mean,
God, yeah.
it's August. Like, just
There's this whole thing. Well, that's a whole TikTok trend. I mean, or I blame TikTok for all this because essentially, if you're looking for Halloween stuff right now, you're already too late. Like it's selling
mm.
out. It's crazy.
But the crazy thing is that my wife does like this huge Halloween spread in the front yard, and she's complaining about things being more expensive to buy, weird trinkets for the lawn. So um this is what I mean by consumer behavior is slow to change. If we start to see that change, I think it starts to happen by Black Friday-ish. Or between Black Friday and Christmas, but I still think that people are going to hold out for that last big holiday, and then pull back in the early part of next year if tariffs are truly having an impact at the consumer level. We
Yeah.
aren't seeing that yet, but if we begin to see it, that's how I think it starts to happen. That's how the dominoes begin to fall.
And we also we've some of those things with the big beautiful bill that haven't really kind of gone through yet with and then that should
Mhm.
start happening in September with some of the healthcare prices going up and all that sort of stuff. So all important things to watch. So that gets us into this week. As John mentioned, it should be a little bit calmer week. I know someone in the chat asked about the Jackson Hole Symposium because that is coming up later this week. So I think one of the things, and I'll let John talk to this one as well, but uh, the FOMC meeting minutes on Wednesday, I think, will be crucial. You're starting to see a little bit more dissent in the ranks of the board, and about what they should
Let's
do.
be careful. Let's be careful there.
Well,
Okay. So the media, kind of talked about this last week. The media made a big deal out of two votes for rate cuts, but
mhm.
that needs to be in the context of both of those members, Bowman and Waller, were under consideration to
Oh
replace
yeah,
Jerome Powell. So,
yes,
but the
but
meeting, but
there's
what we want to see is, was there anyone else who went along with the vote to hold, but was
who's
willing to
not in con
consider a cut?
right, right, right.
Yeah.
I get
Okay.
all that, but I'm just saying, there's some arguing back and forth when for the longest time we didn't have any arguing back and forth, despite what the rest of the market wanted and what the people wanted and whatever else, nothing. So the question is, does that start getting into do those two, start infiltrating the rest of the group and start changing
Mhm.
things? So I think,
But we know there will be three at a
well,
minimum now.
right, right, right. So I do think that the meeting minutes almost are more important than the Jackson Hole Symposium coming up later this week. However, so actually, well, before I get into the next slide, John, do you have anything you want to talk about Jackson Hole as far as
Nope. Nope.
yeah,
I think
no.
you've got it covered.
So it is important to sort of put things in context in that, I think the meeting minutes are probably more important this year. However, there is always a chance for the 2022 surprise. And if you tried to forget about 2022, I don't blame you, but that was when Powell came out all of a sudden very hawkish about everything, saying that we're going to bring down inflation, even if it meant pain for households and businesses. Um, and and then the rest is sort of history. We thought really July 2022 was kind of the end of the or we thought that would be like sort of the bear market low. Turned out it wasn't until October, primarily really because of the negative side that came out of the symposium in August of 2022. And that's actually kind of what that slide looks like. In August, we had broken out from the previous high. We were kind of getting up to the high in May. So a lot said, hey, we're breaking that downward trend. And then that big red bar right there was the day that he said, no, we are fighting inflation no matter what. So the question is, and then in 2023, he came out a little bit more dovish and said, oh, yes, we're still fighting inflation, but there's a lot of different ways that we can do it. So that is the question. And there may be some volatility. It may take a little bit of time to get out of some of the option or get some of that theta decay in options until later this week. I don't think it's going to be a major event, but it could be enough where market makers hold on to things until the event happens. But I'm expecting more fireworks, if any fireworks, out of the meeting minutes than the actual symposium. But that is just me. All right, so sector rotation. Last week we talked about how there were quite a few sector. All these green checks were saying that that this was a better number than the previous week. Consumer staples had I was like, whatever it was, went from 30% to 68% or whatever that was. So these sectors were all had an increase in stocks trading above the 20-day moving average. So that was what we talked about last Monday. There were a couple of ones that either real estate stayed the same at 23%, and only consumer services and utilities were the only two that actually went down from the previous week. And so what that ended up doing is that translated into the S&P gaining about 1% last week. A lot of that, there's a few different reasons. One, we'll talk about UNH in just a second, but that brought up healthcare stocks and utilities, which we had been talking about for a couple of weeks, saying, hey, look for utilities to start unwinding. That kind of finally came true last week. As far as 3 months go, though, the S&P is up 9%. Interesting to me is only communication services and only information technology. So essentially what John just spent all of his money on this past weekend, those are the only two sectors that are beating out the S&P 500. So it's just sort of an interesting data point to look at. You'd like to see a little bit more
So my question
broad-based
on
sector taking place. Yeah,
my question on the information technology is how much of that is driven strictly by
Max 7.
through
Yeah.
two or three stocks in the
Yeah.
AI sector.
Yeah. I mean, same with communication services, right? So it's kind of that theme all over again. So as far as this week goes, there's a couple of good parts in this. One, I don't look at this as like, oh, communication or consumer discretionary is at 69%, therefore it's a buy, or 69% this week versus 40% last week, so it's a buy. I'm looking at this particular column more as oversold and overbought conditions. Because in fact, if you actually go back 2 slides, consumer staples had the greatest increase from the previous week, and then consumer staples actually went down last week. So again, I'm not looking at it as an oscillator of like, oh, when it gets 20, whatever. It's more just kind of giving me a range of what to look at and where to narrow down some scans. So the good news is that within the S&P 500 as an overall index, only 52% consumer, most of these are all within 20%, or higher, and less than 80%. And that's kind of the sweet spot of, I'm not saying that just because it's in the middle that sector is going to go up. I'm not saying healthcare is going to continue to go up this week. What I am saying is I don't believe anything is overbought, and I don't think anything is oversold. or most of these are not overbought, oversold, and that puts things in a good light. Real estate is a little oversold, getting down to only 19% of the stocks in that sector being above their 20-day moving average. Again, not saying that that's immediately going to turn around and go higher. We saw utilities took a couple of weeks, but utilities was up at I think it was 80 or 90% of stocks were trading above their 20-day moving average. It it took about 2 weeks, but then now that's finally dropped down to about only 45% are trading above their 20-day moving average. So that entire sector definitely had some weakness. So real estate is interesting to me, try to find those strongest stocks within that sector. Communication services, again, a little oversold. 83% could easily go up to 90%, could go up to 100%. But I would be a little bit lighter on communication services in the weeks ahead. As far as the EU USA, which is the equal weighted ETF of the stock market, the good news is we talked about this on Monday or Wednesday. Said, hey, I want to see prices go above where they were 5 days ago. So if you count 1, 2, 3, 4, 5, we are currently definitely trading above the price 5 days ago. This bar is going to get, these two bars are going to get a little interesting. So to really see movement higher, we're going to have to get above, trading above the close of these two bar. Well, we're already trading above the close of this bar, but we're, in a couple of days, we're going to have to get above 102 on the EUSA. Otherwise, we're just kind of moving flat to lower. So this is a very short-term indicator. There's quite a number of days where this will go green, which is just trading above where it was 5 days ago. It'll go green for 2 or 3 days and then kind of flip back to red. So it's a very short-term indicator, but right now we finally got out of this sort of consolidation period and started moving a little higher. So that is a good sign there. As far as the S&P 500, using Heikin-Ashi candles on a daily chart, also green. So the only thing that I'm a little cautious about here is that the highs for the last 3 days have been basically nothing. They've been flat. They've all been the same. And if you look back through trends, this is only a 3-month chart, but if you count really quick, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13-ish before a red bar, before some consolidation. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 before consolidation. So we're at 1, 2, 3, 4, 5, 6, 7, 8, 9, 9, 10, whatever it is. So, I'm not saying that we're reversing and going lower or anything else. This is, a little bit of consolidation going lower. This is consolidation not really going lower. So, and then we had this one, which is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 before a drop. So we are just a little bit long in the tooth of the green bar Heikin-Ashi trend on the S&P 500. As far as why the Dow went a little crazy and what helped kind of lift markets last week as well, came out that Warren Buffett bought 5 million shares of a $304 stock. I don't want to do the math on that one. But over the last quarter, he bought 5 million shares of UNH. And so now everyone is saying, oh, yeah, UNH is great. UNH had a lot of missteps. Which sadly led to their CEO being assassinated. But over the last couple of months, Berkshire, Buffett, his team have been meeting with the different with the CEO, VPs, whatever, and have been accumulating shares. Now the nice thing is, I guess if you count back 3 months, he's been accumulating shares about at the same level. I know this is a percentage, gain chart, but it's essentially at the same level. So he's been dollar cost averaging around this 304 level. So if you view that as, hey, he knows what he's doing and he's in it for the long term, and he was buying at 304 and it's currently still at 304, then maybe UNH is a buy. Just remember, as so many people follow Buffett, it always makes me laugh because he is talking about trading a $1 billion account, and I'm trading not that. So his investment style, his deals that he's able to make outside of the stock market, vastly different than everyone else. So when everyone else follows him, you just got to be a little bit cautious on that. You're not even playing in the. It's not even the same ballpark. It's not even the same game. He's playing his own game on that one. So just doing a quick trade recap. Last Monday, we talked about Vital Farms, VITL. That was going for about 295 pre-market, currently standing at 391 as of Friday. So that one is doing good. Going along that same idea of a 10 period moving average crossing above a 30 period moving average, and both of those moving averages being above the 200-day moving average. Not too many came up last week, but there was a company, I don't even know how to pronounce this one, don't know anything about it, to be completely transparent about that. But it did hit a scan. The $10 in the money option, just on a long call basis, was going for $1.67 on Friday. What was interesting, what caught my eye on this one, this was an earnings report date 2 days ago. It had 300% of its normal moving, or 300% of its normal volume that day. And we had some moving average crossovers. And so we'll see what happens with that stock, but that is certainly one that I'm putting on my radar. It's not really an MTC. It's honestly, it's not really a trader's reserve type trade, which is why I brought it to Breakfast Club, because we don't do a lot of just straight long debits or even buying stock. We don't do a lot of that, but it was one that came across my scans, and thought was a little bit of an interesting setup. Yeah, I don't love the doji. Maybe you can time your entry a little bit on a shorter time frame chart, but certainly an interesting stock nonetheless. The other one I wanted to give you was a seasonal trade. This is Lulu going into 2024. So this is last year. Lulu downward trend all the way through August. I mean, I don't know what moving average you want to look at. What, I guess we were lower on the Bollinger Bands, whatever you want to look at. That's where it was sitting right around this time in August of 2024. And then it just all of a sudden shot right up. And it was just prior to earnings, a couple of weeks prior to earnings, and that move happened. So that's kind of where we are right now. Very similar chart. Lulu is, heading lower for the last couple of months. Hitting a Bollinger Band. I don't know. It's less than all of its moving averages. So, normally you stay away from all that sort of stuff. But 9 out of the last 10 years, this time in August, Lulu finds ground and moves higher. Will it this year? I have no idea. 9 out of 10 times certainly doesn't. 100 or 10 out of 10 times doesn't mean that it's going to do it this year. But if you were interested in something like that, you can buy a September 12th $200 call, and to help offset that $14.30 debit, you can sell a 205 for $12.18. Gets your total net debit down to $2.12. What I like about this one is the max profit, because you are selling that 205. The max profit is $5 minus the debit you pay. So your max profit is $2.88. You only paid $2.12, so that is a potential for greater than 100% return on capital if you want to go that route. And there we did it, still did it in 30 minutes. That's all I have.
Okay.
We do have a question.
Yep, I'll take care of Joe. Joe,
Okay.
that's a great question. Let me check in with Dave once we get Income Madness up and out of the way today, and we'll get an answer back to you and everyone else who may be in that IBM trade. It's a great question. I don't actually have an answer for you, but I will get one. So thanks for letting us know, or let us know that we have ways to handle it. We'll find a way that works for everybody. Other than that, Jeff will be back. Jeff and I will be back on Wednesday morning at 8:30, and we'll see what the market brings us. So again, MTC at 11 a.m., Income Madness Week at noon Eastern in the Income Madness channel, and that's it. That'll be the trading for the day. So hope everyone has a great week, and we will see you again on Wednesday.